I'm James Turk. I'm a director of the Gold Money Foundation. I'm here with Eric Sprott, the founder and chairman of Sprott Asset Management. Eric, I want to start off right away with silver. You've called silver the asset of the decade. We're at 41.66 as we speak. What are you seeing here?
Sure. Well, obviously, I'm very optimistic about silver for a number of reasons. Reasons that most people wouldn't know about are the use of paper money in the silver market. And at the peak, when it was 49.80 or so, there was something like 800 million ounces of paper money trading. And we know that there's about 1 million ounces of physical silver available each day for investment. So this preponderance of sellers just seemed unbelievable. And whenever anybody talks about the speculators in silver, I always say, well, who's the speculator? The guy buying it or the guy selling it? Who doesn't have a hope in hell of delivering it? And so we have this big short position in silver, and I'm sure it's going to resolve very positively to the upside. One other thing I should say about silver is I look at the sales of silver versus gold. The U.S. Mint sells more dollars of silver than gold. The Canadian Mint sells about $1.50 of gold to $1 of silver. I know Gold Money probably sells more silver in dollars than gold.
That's right.
Sprott Money does the same thing. So I see this as a decision by people to decide one versus the other. And they can't keep buying at a 1-to-1 ratio when the price of silver to gold is 40-to-1. So I'm sure it's going to resolve to the upside.
That's an interesting distinction that you're making, that the specs in silver are the paper shorts, whereas the serious players in silver are the physical longs.
Right.
I haven't really heard that before. That's really an important distinction. Yeah. What's likely to happen to the paper shorts?
Well, I mean, they already got seriously burned, okay? I mean, we had the price of silver go from 18 to 48. I mean, there was this massive short position. I think it might have been 600 million ounces at least, let alone what's in the derivative business.
Yeah.
So when you lose $30 on 600 million, you've lost, $18 billion. And that's why I think the raid happened on May 1st. It drove the silver price down so they could get off some of their shorts, but they still have a pretty good short position. Ultimately, they're going to go the way of fiat currency, I guess.
Do you expect a force majeure, that they're just going to renege on the contracts?
Well, there's no way that they can deliver to the contracts. We know that. I mean, there's not enough silver.
There's not enough physical available.
There's not enough physical silver. I mean, we've done analysis of the silver market, and I take my point of view on the silver markets go from 2005 to 2011. And I can see 4 or 5 entities that change their demand by a total of 380 million ounces. Lack of U.S. government selling. Chinese going from exports to imports, which changed by 200 million. The U.S. used to sell 100 million. The ETFs coming along, which are buying something like 60 or 70 million ounces a year. You add all those up, we can come up with 380 million ounces in a 900 million ounce market. And I always go back and say, well, who was buying it in 2005 that can't buy it in 2011? Like, who is that person that's not buying the 380 million? Huge change in the supply-demand situation in silver.
So you're more bullish on silver than you are on gold? I mean, you're a long-standing gold bull, and it's well known that you're very bullish on the metal of kings, but you're even more bullish, is it fair to say, on silver?
I mean, the line I use is that gold was the investment of the last decade, and I think silver is going to be the investment of this decade. And I do believe in the thesis that silver will get back into a 16-to-1 ratio to gold. So gold's over 1,600. So theoretically, silver could be $100. It's at 41 and change. Gold probably goes to some number that's, stratospherically higher than it is today. So that means that silver is going to have a great move. The historical relationship was 16-to-1. I see the buying coming in at 1-to-1. I see the supply of gold above ground in dollars is approximately 100 times greater than silver. But the buying's 1-to-1, so something's got to give somewhere.
How long is this going to play out? Are we talking months here? Are we talking years?
Well, my expert for predicting the price of silver is you. And by the way, great call just a few weeks ago when you said the second half it's going to get going. And I really do commend you on that. It's a great call. You just see things developing in the market that could make it explode at any moment in time. I always think, well, in 3 to 5 years for sure it'll trade at 16-to-1. When it actually happens, I don't know. It could get parabolic at any moment. I mean, we have a financial system that's on the edge of a cliff here. So all I know is that you can safely own it, go to sleep at night, and you'll be a winner at the end of a certain time period. And you'll be a big winner at the end of that time period.
I try to conceive why or how somebody would take a short position in silver here, given the extremely bullish and positive fundamentals. Is there any logical thing?
Well, I mean, the only logical thing, and that's what GATA has been after, is that the cartel is always trying to suppress the price of gold and silver. And in fact, I'm of the opinion laterally that knocking silver down was intended to keep the gold price weak. Because silver is easier to move. I mean, it's a very small market. Somebody with money and the printing press or the electronic button can keep the price of silver down, which has a negative spillover effect on gold. It wasn't very effective this last time. As you know, gold only went down 6 or 7%, but you know, silver went down over a third, I guess. And of course, it just stormed right back here again. So
that's because of good physical demand
Sure.
under the market, and you can't create physical silver out of thin air like you can create paper out of thin air.
And I think, quite frankly, one of the reasons gold didn't go down that much is, you know, there's latent physical demand for gold. We just saw the Bank of Korea announce that they bought 25 tons. Mexico bought 93 tons. So the paper boys can do all they want, but when the orders come in to buy it, they have to stop the game.
Okay.
We just raised in Sprott Physical Gold for another $300 million, so we've been to buy our gold recently.
Okay, Eric, let's get into gold a little bit. You did this offering, but timing was part of the factor behind it?
Well, we had a good premium. There was an interest in it. We thought it wouldn't disturb the market.
This is for PHYS, Sprott Physical.
The gold trust, yes. Yeah. We raised about, I think it was 320 million gross, something like that. Of course, you got to pay underwriter's fees, so it'll be a little less than 300 million to us. And for the most part, we purchased all the gold. We may have another 20 or 30 million dollars to buy, but it's not a disturbing number in the gold market, as you know. I think South Korea, when they spent 1.7 billion on gold in the last 2 months. So, but I think gold's going to be incredibly strong here. I do the same thing with gold I did with silver, except I use my starting year as 2000 compared to 2010. I look at the dynamics of change in the market, and this is basically a 4,000 ton a year market with mine supply hardly having increased in a decade. And then you look at some of the big macros that happen. We have central banks are sellers of 400 tons. Looks to me like they'll be buyers of 400 tons. There's an 800 ton shift in the 4,000 ton market. You have the ETFs that started in, I think it was 04. And I don't have the number in the top of my head, but I think on average they buy something like 60 or 70 tons a year. I look at coin sales from the various mints. I compare 2000 to 2010, and they're up by factors of 800 and 900%. And I actually came up with a total, and I will discuss this at the GATA conference here, that we can identify 1,900 tons of positive change in the fundamentals for gold, other things being equal, in a 4,000 ton market. And I keep, scratching my head, where's the gold coming from, or who's not buying it in 2010 that was buying it in 2000? And it never makes any sense to me that there's so much demand and supply is almost constant. So I just got to believe that we're going to overrun the paper shorts, and in fact we'll probably have a physical shortage in due course.
Yeah, so there's so much paper gold out there, but only so much physical gold, and ultimately that's the driver.
Right. Well, we can see, when you see these central banks, I find it very instructive that the Bank of Korea's bought 25 tons in the last 2 months. And all I can think of is, what are the other 30 central banks around the world thinking? They see Mexico buying, they see South Korea buying, I think Thailand bought. Sooner or later, you're going to get other central banks that, we got to get in this game here. So I think there'll be a physical shortage for sure. We don't see much increase in the gold production. Most major mining companies are stumbling with production, so we're not going to get much of an increase this year.
Given that the spot market is both a function of the physical market as well as the paper market for gold, I wanted to ask you, because one of the things I follow very, very closely is, backwardation, whether gold is in a normal contango or whether the front month, the spot month, is above the futures month. And so far, it's remained a normal contango, spot and working on up. But if you look at a fund like PHYS, it's always trading at a premium to spot. Isn't that a form of backwardation in the sense that you're much closer to physical metal than a lot of the spot market is, because there's a lot of paper involved in the spot market?
Well, I think that a lot of people have a distrust of both the Spider Gold Trust and the Silver Trust, the SLV. And so they're willing to pay these premiums where they trust people to have the metal there, and particularly if they can have access to it, which in the case of our Sprott Physical Gold Trust and the Silver Trust, they can get access to it.
Yeah, PHYS for the gold and PSLV for the silver.
Yeah, and the silver premium.
Getting access meaning that they can actually take the shares and redeem it for physical metal if they choose to.
If they choose to. And as you know, the one time people might choose to is when things go extremely haywire. And you might say, hey, I want this physical precious metal in my possession rather than a piece of paper. So I see our PHYS competing with the GLD. I think it's a better instrument. You know, when I look through those numbers and wonder how could all this physical gold be showing up, it even makes you wonder, well, maybe the GLD doesn't get the gold they're talking about. Now, I don't pretend to be an expert on the GLD, but I always wonder about the mismatch of supply and demand and how that's working out in the system.
Well, you know, there are different buyers of gold. There's some people who actually want the tangible asset so that they have everything that that tangible asset brings to the table. And there are other people who are just happy to have exposure to the gold price, you know, the professional traders and the speculators. And to get that exposure to the gold price, they might buy a futures contract or an options contract or maybe GLD. Because with GLD, you don't really own gold. You own shares in a company that, or in a fund that's supposedly backed by gold.
And of course, the number of people that are willing to buy things electronically, as I pointed out in the silver example, I mean, it's a ratio of 800 to 1 in the sense of the trading versus the physical availability. I don't even know what the ratio is in gold, but it must be some incredible number of times the physical amount that's available that trades every day. So, and I always say, well, what are the sellers thinking? You know, what are they thinking? They know they can't deliver.
Yeah.
So,
well, isn't that a sign of the times, though? A lot of speculation, a lot of paper. And as we work our way through this financial bust, we're ultimately moving back to basics, and gold being money for 5,000 years is one of the most basic of them all.
Sure. And by the way, James, I give you credit all the time for explaining it best. And you use the words, it's a managed retreat. And that's what I think it is. You know, there's a shortage of gold. You can't let it get too emotional or parabolic. So, for example, I was very surprised to see the 2% day on, I guess it was Tuesday. It was very uncommon, even though gold should be the most emotional commodity out there, but it's the least emotion in terms of price. And I happen to be in the camp that believes that there are hands out there trying to keep it under control. They've lost the battle, but they're willing to fight lots of little wars on a daily or weekly or monthly basis. So
I'm going to be actually talking about this managed retreat in my presentation tomorrow at the GATA conference here, and explain a little bit about it. But the fundamental thing is I'm going to explain why, even though the price is high, gold still remains very, very undervalued by all historical measures.
I think the best chart, and I will show this in my presentation, is that the world has 200 trillion of financial assets, and the gold market's worth 3 trillion. And theoretically, the central banks own half of that, which is 1.5, which means investors own another 1.5 trillion, which is 0.75% of all the financial assets that are in gold. Well, as you well know, there's been many times when people recommended 5 or 10% interest in gold. Somebody like me, I have almost all my money in gold. Someone like you has probably by far the biggest part of your
But a lot less in the aggregate.
Yeah, but the fact is nobody's in it. And when you look at the pool of financial assets, it probably hasn't even grown in the last 10 years in the sense that the stock market's done nothing. Gold's gone up by 6 times. Well, what was the weighting in 10 years ago?
So the percentage has risen slightly, but that's because gold's price has gone up, not because there's that much more money coming into the sector. So it's 0.75% now. What is the historical norm?
I don't even know what the history. I know that many people talk about 5 or 10. In fact, I don't even think history will mean anything when people all realize they have a problem with their money in a bank or owning some government note. I mean, the demand for gold could become overwhelming. I mean, it could just be, as you predicted, and many others, it could be parabolic all of a sudden. They just realize that this fiat currency is not worth what it's made out to be. I mean, I always think of fiat currency as trust the government. I always wonder, well, why would history tell us to trust government? I mean, you'd think
given the record,
it would tell you the opposite.
Yeah.
So.
I mean, even from a diversification point of view, to mitigate risk, You need to own some gold, you need to own some silver. You have to have a tangible asset for your monetary asset rather than just fiat based on nothing except politicians and government rhetoric.
Right. You have to own it. You have to own it yourself or have access to it. You have to own it through trustworthy people like yourself, like ourselves, people who have pledged themselves to try to get people to get into precious metals for all the right reasons for the last 10 or 11 years or even longer for that matter. So it's, I love coming to conferences like this. I'd like to be more of a spokesperson for silver and gold. I'm always trying to encourage Canadians to own it. We've created lots of different funds that they can invest in. And has been the way it is. I mean, it's shocking that it's been the best asset for the last 11 years, and we can still hardly muster up a real surge of common interest in it, but it's coming.
But, I mean, you've reached out beyond Canada. Your PHYS and PSLV are listed on the New York Stock Exchange.
Right.
And so people from all over the world can participate in your funds.
They can. And I'll tell you one of the latent things in silver. When we sold the Silver Trust, we raised $550 million. When we sold the Gold Trust, we raised $440 million. So again, it's another example of people being more willing to buy silver than gold. And I would say if I was prepared to sacrifice the premium on PSILV, which I'm not, compared to the 300 we just raised in gold, I could do multiples of that in silver.
If the physical silver were available?
If it was available and I was willing to sacrifice the premium. I'm not willing to sacrifice the premium.
Yeah.
And I have to find ways that we can do it without sacrificing the premium. But I know the demand is there.
Yeah. Is it retail or is it institutional or both?
I would say it's mostly mostly retail. Both times when I've done the circuit trying to sell these issues, certainly on the IPOs, it's probably been 80 to 90% retail. I was very much shocked that when I tried to tell the silver story, that I wasn't getting much resonance with institutions whatsoever. In fact, very few of them had even looked at it. People who invested in gold already hadn't even looked at silver. So I kind of know that that's coming. You know, it's just like you recommending gold in 2000 and some people coming along in 08, such as John Paulson and David Einhorn buying gold and everyone, oh my God, it must be a good investment. Yeah. But they're 8 years late to the party, right?
But still early in terms of where the bull market's going to go.
And they've done very well by it, and they will do well, of course, going forward. But it takes that kind of time period for people to kind of latch onto it.
You know, it's interesting the point you raise about silver, and I think I may have an answer as to why the lack of interest is there. It's, you know, every bull market has 3 stages, and in that first stage you see apathy and neglect and disbelief. Silver's still in stage 1. It's been my point that we're not going to go into stage 2 until we're over $50, which was the January 1980 high, and I think that's likely to happen here in the not too distant future. Once that happens, then that's going to go onto people's radar screens, and you go into the second stage of silver's bull market. So maybe in a year's time, when you make that circuit, you're going to get a lot more interest than you do at the present.
I can feel the difference already, right? I mean, it was a year ago, almost a year ago, we did the
I mean, who thought $50 silver a year ago was possible, other than a couple of people like ourselves?
It was quite predictable. I thought, anyway.
When it comes to markets, nothing's predictable, but it was an easy call.
Yeah. It was easier than most.
Yeah,
I mean, you looked at the history and said, oh my God, if this thing goes back to 24, it's going to 50 almost automatically. And it did. And it did it almost in the time frame that you would have imagined. And so when I was on the roadshow, I said, if it goes through 24, it's probably going to 50 in like 4 months. Well, I think it took 6. Well, who's going to argue over a couple of months, right?
Yeah, particularly given the double in price.
Yeah, exactly. So I think the investors are coming around to it. I was actually a little in dismay when I've been listening to some of, the bubble vision, and like every third guy likes gold now, or is willing to admit that maybe you could have gold in your portfolio, which was disturbing, having gone through the 11 years when no one would even mention it, or as a barbarous relic or whatever. And so I kind of monitor now how many people talk about silver. It's not many. But you can see it creeping into the conversation. So.
But gold is in the second stage of its bull market since it went over 1,000 an ounce. So you can expect to have more people talking about it. But the question is not talk, but whether they're doing it. And given the fact that this percentage of assets is still 0.75%, which I keep coming back to, it shows that this is an under-owned asset compared to, say, the US dollar, which is an over-owned asset.
Yeah, they're going to come back. I mean, You know, it's having dealt with large institutions and pension funds, they're so rigid in their programs, you know, that they can hardly consider owning something physical. I mean, it's so against the grain of what their advisors are telling them. But, you know, gold having gone up by whatever it is, 700% here, I mean, the advisors are coming around, and of course, seeing silver up and seeing all the other commodities go up. They're finally giving some credence to investing in that area, and it'll be slow. I mean, we saw the first example of, I think it was Texas teachers by close
Well, I was going to ask you about that. Was that sort of a watershed event, and that sort of added some legitimacy to the sector and the institutional investor side?
Well, I think John Paulson going into GLD, David Einhorn buying physical, the Texas teachers buying physical, those are huge eye openers, and some of the central banks stepping in to buy gold are sea changes in what's going on out there, and it makes it more acceptable for the mainstream to come in, who'd never even considered it before. Okay. But it's still a tough sell. I can't tell you how difficult it is.
Let's go back to something you just mentioned a couple of minutes ago about gold going up $32 in one day beyond the 2%, right. Which, you know, GATA has contended that you have certain mechanisms where the intervention occurs. It's either 1% or 2%. Right. This is the first 2% day this year. Yeah. Is it an indication, in your view, that maybe the people who have been trying to keep the gold price suppressed are just losing control? Yeah, I have no doubt that they are losing control. Particularly when you have these people like Mexico and South Korea and us raising $300 million. We're all coming into the physical market, and so the paper market can't deal with it. I mean, we have not had an increase in mine production hardly in the last 11 years. And I know they're expecting an increase this year, but when you look at some of the semi-annual reports, I mean, these gold companies are having a tough time increasing production. They're starting to miss their estimates. So I think it's a sign that they're losing the battle, and I don't know how the managed retreat is going to be. I'm sure you'll explain that to us. But, well, eventually the managed retreat turns into you know, total shambles, and they just run for cover. First man, you know, is the one who's going to be saved. So it's sort of interesting, James, when you think back to, you know, you were on board when gold was at its low of $250. Well, just think of a $32 price change in a $250 item. Yeah. I mean, it's a staggeringly large gain if you just would stay the course. And that's how the investment becomes exponential after a while. Like a $1.20 move in silver to someone who bought it at $5. It's 24% in a day. And, you know, as Bill Murphy would say, there's probably just jacks for openers, right? Yeah. So. Yeah, I'm very bullish on both the metals going forward as you are, but the other side of that coin is it's really being dollar bearish or fiat currency bearish. Yeah. Because that's the issue. It's a fight of the currencies to see which is the worst, or which is going to be the worst first one to collapse. Well, let's talk about that a little bit. Some big picture analysis. I mean, you know, move away from the markets and move away as to, you know, the way things are moving and evolving. How do you see the financial system, you know, changing? I mean, let's be honest here. Most banks are insolvent. Right. They're way too over leveraged. Right. I don't think there are enough government resources to bail out banks if there's another Lehman collapse, but you know, any one of a number of potential candidates, including countries, could be the next Lehman. How do you see this evolving? Well, I've always believed, and I believe this as a chartered accountant, how can you be levered 20 to 1? You have 5 cents of capital supporting $1 of paper assets. And everybody knows that any paper asset could move 2 or 3% in a day, anything. It could be a government bond, it could be a Spanish bond or Italian bond, which will move 2 and 3% negative in a day. It could be a mortgage security, it could be the stock market, it could be a commodity. Why would you ever let yourself be levered 20 to 1? And I just think that we grew into this, you know, we created the Fed in 1913. Banks found ways, they got comfortable with the system, found ways of leveraging themselves and keep increasing the leverage all the time, always on the understanding that the situation would remain normal. Well, the situation isn't normal anymore. We have these violent upheavals in the credit markets as we went through the lending crisis in 08. And I see now that whenever you think of the bank's strongest assets, they used to be mortgages and sovereign risk. Well, those might be the weakest assets these days, particularly as I think about a European bank owning sovereign risk
And the banks kept expanding because they wanted to have this great return on capital, and the only way to get more return on capital was to use more leverage. And I think we just wrote an article on it today. So, well, what do you think people in Italy and Spain are doing with the money in their banks? As what they did in Greece, Iceland, Ireland. They all started, it's all well documented, they took the money out of the banks. The governments have to come in and fund the banks. And it's happened all over the world. And the best example I can give to, for example, Americans or people who think their banking system is secure, I mean, every Friday night in the US we have bank failure night. And I look at one statistic. I look at the deposits that each of these banks that failed has and how much the FDIC had to pony up to get someone to buy it. We already know they lost the first 5 cents, otherwise they wouldn't be bankrupt. And then the FDIC...
Assuming only a 20-to-1 leverage.
20 to 1
a lot of these banks were much higher than that.
They might be a lot higher than that. And then the FDIC typically has to come in with 25 cents in the dollar of the deposits. And I just say, oh my God, they lost their capital 6 times over.
Yeah.
Like, it's a staggering number, and it happens week after week after week. Same kind of reference of numbers of the losses versus the deposits.
You know, it's interesting, you're talking about the FDIC and covering these losses and 25% of the assets missing. And you mentioned about, looking at it from a chartered accountant point of view. I'm not a chartered accountant, but I am a trained banker. And I learned banking in the 1960s from a big New York bank. And I was taught by guys who had lived and worked through the Great Depression. And back in the 60s, if a bank was leveraged at 6 or 7 times, 8 at most, that was considered prudent and normal.
Right.
In 2007, I did an analysis of Citibank. It was leveraged at 40 to 1, and that didn't include its off-balance sheet, special purpose vehicles, and that, which maybe doubled it to 80 to 1.
Yeah.
We have central banks around the world leveraged at 50 to 1 or higher.
Right.
It's a train wreck coming?
It's a train wreck coming. There's no way of stopping it. And the funny thing that's happened in the last, since 08 for sure, is that every step along the way, I think the purpose of central banks and governments getting in is to prevent liquidation. Nothing's ever liquidated. The FDIC takes it over. The ECB bails out somebody. The Icelandic government goes and takes over the Icelandic banks. UK buys big interest in their banks. The Irish fund their banks. So there's never been a liquidation. And what are values in a liquidation versus, a value on a balance sheet at some quarter end? I mean, a liquidation value would be considerably smaller. In fact, there would be no market.
Yeah, but you always run the risk of throwing good money after bad. Isn't that what governments are doing?
Totally. But they're caught between a rock and a hard place. They think, the system's going to collapse if I don't do something. And they're right. It will collapse if they don't do something. So they do something. And then, of course, now the governments are going to collapse, just as the Greek government's done, the Icelandic government, the Irish government.
And maybe Italy or Spain.
Yeah.
Or it's just
now
or
the governments
UK.
will go down because who's really funding all this thing?
Then what happens?
I have no idea. I mean, it's not even interesting to think about what really happens in the real world.
Yeah.
Like if the banking system shuts down, that is not an outcome that you want to contemplate. And I don't think the government's coming and said, trust us, we'll take care of the banks. I mean, that's what it's over anyway, because we no longer do trust them.
Yeah.
That's why they're going to go down. So, the ATM machine's going to work. Is commercial trading going to work when there's no finance mechanism? I don't have any idea, and I don't spend too much time on that. All I know is that people, to protect themselves against that happening, have to own some physical precious metals, because it will be something that will be usable no matter what the situation is.
At some future date, will gold become overvalued in your view?
Well, people ask me a question a different way. So, what are the things that would make you sell it? I said, there's 3 possibilities. One is if I see a mania in the market. It's just somehow I see crazy things happening. Okay, fine. This reminds me of NASDAQ 2000, and maybe I'll get off the train. The other one would be if governments became responsible. Governments and central banks became responsible would be the second reason. Luckily, we don't see that reason at all. And the third reason that you might think it's time to get out is where they would make it the reserve currency. Then you don't need to own gold and silver because you can trade for it anytime you want. Maybe you could then consider investing in other things knowing that it was backed by gold and silver.
Would you care to assign any probabilities to those 3 possible events?
Well, I think the probability of a mania is very high. You can feel it coming. I mean, you can feel the interest building in gold all around the world. I mean, you see it, I see it, you see it in gold money, I see it in Sprott money, I see it in our ability to raise $300 million overnight in the Sprott Physical Gold Trust. I can see it in the latent demand for the Physical Silver Trust. You see it in what central banks are doing. You kind of see it in the misunderstanding of the market by the gold producers. I mean, there's hardly a gold producer around who really believes the price is what it is, let alone that it's going to stay there. So there's this huge skepticism in the industry about the gold price. So I think it will go parabolic. I'm going to rely on you to tell me when it's going parabolic, James, because you're the expert, okay?
Well, I don't know. Getting into a market is one thing. Getting out of a market is something different. But what I always say is that gold will become overvalued, not when you're going to sell it, but when you're going to spend it. In other words, I firmly believe that gold's going to be circulating again as currency in some form, maybe digital through gold money or other alternatives. But given the fact that gold has been money for 5,000 years, and we've been experimenting with a money substitute called fiat currency for 40 years, and given the fact that this experiment with fiat currency seems to be going horribly wrong, it seems inevitable we're going to come back to gold in one way or another.
I would think so. I mean, that's the ultimate thing that's going to happen. You need something to back the currencies, and it's got to be something physical. So gold's got to play a big part, silver's got to play a big part. Maybe other commodities do, I have no idea, but those would be the two key ones that are usable, fungible and in everyday use. And that's why another reason why I think silver could be kind of interesting. Imagine if we actually had to go to a real currency that we used in our hands. That's a lot of physical currency we got to create, having created all this paper that might disappear.
Yeah, exactly.
I had a very interesting thing. I was talking to a guy who ran a mint, and he said, there are people buying copper coins. And I thought that seemed really odd to me. I said, well, maybe the guy's really far-sighted and he can see it coming back as a currency, because you need the lower denominations thing to have everyday currency exchange.
Yeah, interesting, interesting. Eric, this video is going to be seen by thousands of people throughout the world. Is there any last comments that you'd sort of like to leave in terms of things that you see important?
Well, I still believe that an investment in silver is a very safe investment today. When we look at the data points, they scream at us that it's undervalued. When you look at the history of what's happened in both the silver and gold market, I happen to believe in what GATA's believe, that there's these hands from the outside keeping things restricted, and they're going to lose control. So people have to be in precious metals if they want to protect themselves, and there aren't many other investments. I mean, that you could consider agricultural investments, but those are the key things in my mind that will protect one.
And that's a specialized area, whereas buying gold and silver are quite simple as opposed to the complexities of agricultural investments.
Yeah, it's by far the easiest. Everyone who's an investor has money. They have it invested in some paper instrument. They should take part of it and own some gold and silver.
Eric Sprott, founder and chairman of Sprott Asset Management, thank you very, very much for being with us today.
James, it's been my pleasure.